All right, now let's get to the airline trade. David Vernon is a senior transportation analyst at Bernstein. David, welcome. Good to see you with us. A lot of news in the airline world to talk about, but why don't I just cut to the chase here? Why don't you tell me what airline would be your favorite stock buy right now and why?
I think it'd be American or Delta coming out of earnings, largely because they've got more limited CapEx needs right now. I think the biggest equity upside in the short term here is going to be through deleveraging and balance sheet repair. And both those companies are in a much better position to do that. You contrast that with the story at United, where they're undergoing a big fleet modernization program, and Southwest, who's going to be spending a lot to try to kind of modernize its systems and avoid the type of disruption that we saw in the back half of December.
I'm surprised American, David, because it feels more risky because of the high debt load. I mean, I take your point about the deleveraging, but do they look okay balance sheet-wise at this point of the expansion?
No, but they're going to look a lot better in a year because they're going to be generating free cash flow this year. They're not going to be spending more on CapEx. They're going to be able to start to deleverage. They're looking at sort of net credit metrics that are back at 2017 levels by the end of this year. That still may be a little bit elevated to peers, but it's certainly going to be away from the nosebleed levels that we've been at for the last couple of years in that stock. And as that equity risk profile as the credit risk profile starts to come down, I think you're actually going to see some relief priced into the equities.
But even if we head into a recession, I mean, I know that for analysts, it's like, listen, that's a binary question. If we're going into recession, you throw this out the window. But it would seem to me that now might be the last time you'd want exposure to companies who are on the riskier portion, of the credit curve versus those who might have the more of the stalwart, the balance sheets where if things take a turn, and the economy is slowing, and maybe that makes that thesis, that calls that thesis for American into question somewhat.
It's certainly part of the risk, which is why the stock is trading at 4 times cash flow for this coming year. But if you think about the potential for demand to stay a little bit stronger for longer into this slowdown, mild recession, whatever we're heading into. If we were in a standard recession where capacity in the industry was very, very high, pricing was and utilization was very, very good, you're heading into recession, you'd have a lot of potential deleveraging happening in the industry as demand kind of came off. Right now, the industry is still running at recessionary levels of demand. Business travel hasn't recovered. There's still pent-up demand for travel that has not been fulfilled. And given where prices are, I think you actually have some travel that maybe is still getting pushed off. Planes are full, prices are high. So travel, remember, is more of an affluent service product. This isn't the type of customer that is going to be trading down mostly for private label products or filling up a gas tank half full. Travel is a little bit more of a premium product. Those consumers' balance sheets tend to be a little bit better. And if we do get to the back half of the year, we start to see the Fed kind of easing off on some of the interest rate tightening, I think you're going to be seeing that this recession looks very unlike any other